We're at a crucial pivot point in macroeconomics going forward, especially here in the United States. So stick around if you want to find out what's going on. What's up, apes? Welcome back to another edition of the 𝗙𝗟𝗡𝗚's daily podcast of the day. Thank you all so much for joining us here once again. My name is David. It is currently 10:29 p.m. on this beautiful Wednesday, September 4th, 2024. A bit of a later recording for us here today, but nonetheless, we are here for you guys because I am done moving across the country, so I no longer have an excuse to miss these, and especially we can't miss them going forward because we got a hell of a lot to talk about. We're at a crucial pivot point in macroeconomics going forward, especially here in the United States. So stick around if you want to find out what's going on. First and foremost, we're going to be diving deep into oil prices, what the hell is going on there, why they're falling so fast, and how the United States and China are kind of inadvertently working together to produce a better outcome for us and consumers. We'll then move into some of the biggest stock moves of the day, of course, giving you our biggest thoughts on names like Tesla, and then also a big cybersecurity company that somehow had a worse quarter than CrowdStrike did. Don't really necessarily know how that's even possible, but of course, we'll then finish it up and talk about why everybody's complaining so goddamn much this year and why it makes even less sense than it usually does. Like I said, guys, my name is David. Welcome to the 𝗙𝗟𝗡𝗚's daily podcast of the day. If you've been watching since the last 30 seconds or so, you know that it is relatively late at night. So let's go ahead and get right into this so that we can, so that I can go to bed at a reasonable hour here tonight. First and foremost, the WSO Alpha portfolio. This is our proprietary in-house portfolio by the apes here at WSO. The portfolio is down about 25 basis points for the session today. Not too terrible considering the S&P 500 was down 16 basis points and the NASDAQ index, which is a closer benchmark for us, was down about 30 basis points. That's pretty much what you can expect from the WSO Alpha portfolio on any given day. We will outperform the NASDAQ on down days, we'll underperform on major up days, especially if it's driven by large cap tech, because we're not fucking pussies. We're not going to be, just following the market, basically closet index providers. We are going to be contrarians, taking actual positions with our stock positions and kind of expressing what we expect going on in the future through our investment portfolio. So come join us for the ride. Subscribe to WSO Alpha. We also just went ahead and published today an update on NVIDIA stock, kind of what the market is seeing in its post-earnings reaction and what you can expect going forward from that thing. We gave a full rating, full price target as well, so go ahead and check that stuff out on WSO Alpha. Okay, let's go ahead and move right along into the banana bits for the session here today. These are all the things that, we thought were worth pointing out, but I didn't care enough about to write about, at least today. First and foremost, this is actually something I'm definitely going to be writing about tomorrow, but the labor market continues to just get cooler and cooler. It might even be cooler than me at this point, which is basically impossible if you ask my mom. But still, that is what the JOLTS report essentially told us yesterday. We're seeing an unexpected increase, or an unexpectedly large increase in the number of job openings out there. So once again, continued cooling in the labor market. Moving on down, Democrat nominee, current vice president, you know her, you love her, maybe you don't love her, but her name is Kamala Harris, and she basically came out and quelled concerns about wanting to raise the capital gains tax rate up to 45%. She basically came out and said, hey, chill out, guys, we're only going to raise it to about 28% or so. If my portfolio had any capital gains to worry about, then I might be a little bit concerned about that side of things, but I'll let everybody else do the fighting for me. Moving on down, commercial real estate delinquencies continue to rise across basically every bank, basically every city. It's just kind of one of those markets that's going through a very slow domino fall right now, and we all know why. It's because of the interest rate game. Just ask Silicon Valley Bank what happened to them. Moving on down, the Wall Street Journal, they published yesterday a list of the best colleges in the United States, or I should say 3 lists of the best colleges in the United States. I guarantee it is going to blow your face off with how surprising it is. Clearly, this was written by a graduate of Babson University, because otherwise I have absolutely no idea how you get the order that you do right here. But nonetheless, go ahead and check that stuff out if you care about prestige or any of that bullshit at all. Finally, in case you're not ready to throw up enough from political discussions in the United States already, don't worry, YouGov has your back. They recently ran a survey, I guess, polling liberals and conservatives about what their favorite brands are. So apparently anything from your preferred breakfast provider to your preferred ice cream and, of course, your favorite charity to donate to can tell a lot about your politics. Okay, let's go ahead and get into the big story of the day here today. We are, of course, going to be talking about oil prices. Now, this is something that we haven't talked about in a while, just one kind of commodity or one segment of the market and what exactly is going on in there. But considering the fact that oil prices just dropped to a 9-month low, reaching as low as a very not so nice for the producers, I guess, $69.19 per barrel, then it's something worth talking about here. So let's go ahead and figure out exactly what's going on in this market. So later on, we're going to talk about how every fucking asset class in the world has been firing on all cylinders so far in 2024. But the odd man out, or the odd asset out in this case, is commodity prices and especially oil prices. Now, crude oil prices in the United States are down about 1.31% since the beginning of this year. But since their peak so far this year, which occurred earlier this year towards about the beginning of April, I believe it was April 5th that the actual peak came in, we're down about 21.12% from there. So if this was the stock market, we would call that a bear market once it's in that 21. Once it's over 20%, once it's in more than a 20% drawdown, it's in a bear market. So you could effectively say that oil prices are in a bear market right now. So what's going on? Well, there's three basic large factors that are driving the price of oil in the United States. And first and foremost is OPEC. For those that are fortunate enough to have not suffered through a macroeconomics class just yet or a geopolitics class just yet, OPEC is the Organization of Petroleum Exporting Countries. Now, think Saudi Arabia, think basically every Middle Eastern country. They control about 40% of the total global production supply and about 80% of proven reserves in the world. And this is essentially a cartel that basically decides how much oil we're going to produce as a way to control the global price mechanism of oil. So they basically say, you know, if prices are getting a little bit too low for them, they'll cut production. Cutting supply will, you know, basically, we all know the rules of supply and demand in economics. When you lower supply, generally price is going to increase if demand remains the same. That is kind of what OPEC has been trying to do recently, but a little bit of the opposite way. So we've seen oil prices surprisingly continue to increase for a couple of months, and as a result, OPEC had basically said, you know, we probably can afford to be producing a few more barrels per day and still maintain a relatively attractive price for producers. And so through a very roundabout way, the cartel had planned on increasing daily oil production by about 180,000 barrels per day, beginning in October of this year and extending that through September of 2025. That has been put on hold right now because concerns, especially concerns coming from China, have thrown the picture of global oil demand very much into question. So economic woes in China have been kind of, you know, putting the country on the brink for a little bit there in terms of both consumers as well as businesses. Basically, what they're expecting is just much slower GDP growth due to lower demand. It's, you know, I mean, China is plagued by very broad demography issues, but really what's going on right now is basic problems that still extenuating from the post-COVID era and from the zero-COVID environment that China had engaged in. So what's going on over there is a broad economic slowdown across sectors, across participants in the in China's economy. And so what comes with that is obviously going to be a lower demand for energy. If you're doing less things, if you're producing less things, you have less of a demand for energy. So at the exact same time that OPEC was considering increasing their oil production, China's demand, China, the largest consumer of energy in the entire world, is considering, well, not necessarily considering, but their demand is going to be falling. So that's two things kind of pulling prices of oil lower at the same time. Then the United States enters the chat. Now, the United States has something that's called the Strategic Petroleum Reserve, and this, surprisingly, is a reserve of petroleum that's maintained for strategic purposes. That's essentially what it is. Basically, the big fat pile of oil that the federal government can decide to drain when they want to lower prices domestically and have a little bit of influence on the global oil market. So, since the COVID pandemic, there's been quite a lot of concerns about access to basic supplies. Like, this kind of all stemmed from a fear of not being able to get N95 masks. And then, you know, there was a whole lot of beef going on related to the petrodollar and whatnot. The United States basically just said we need to have more control over our oil production. Rather than allowing things like the Keystone Pipeline where we can actually start to produce more, we figured, fuck it, let's go ahead and just drain the oil right from our strategic reserve, even though this isn't a wartime scenario, which the SPR is typically going to be reserved for. Nonetheless, the Strategic Petroleum Reserve in June of 2023 hit a low not seen since August of 1983. That's over 40 years, probably before 95% of you watching this were actually even born. So At the exact same time that OPEC is considering increasing their production, China's demand is falling. The United States has been dumping buckets onto the global stage and really onto the domestic stage, but it has an influence on the global market because the US is also a large consumer of oil. If we're just dumping from the SPR, we have less of a need to import oil from other countries. So that's three major mechanisms right there that are pulling the price of oil lower. That's exactly why you see the decline that you've seen since April so far of this year. The question going forward, how much of this can we expect to continue into the future? Can an interest rate cut in the United States, is that going to weaken the dollar enough where oil prices in relation to the US dollar start to increase? Who knows what's going to happen going forward, but consumers, businesses all around the world, everybody, let's just take a step back and enjoy the low oil prices that we have right now. So they're probably not going to last for too much longer. Don't be surprised if OPEC doesn't go through with those production cuts, if anything, or those production increases. If anything, expect more production cuts to come. Okay, with that said, we can go ahead and move on into some of our big stock movers of the day. First and foremost, we have GitLab. What I learned from this earnings report is that I should have paid more attention in IT 101 class, because then maybe I would know what a DevSecOps platform is. Nonetheless, that is what GitLab is. This is a major player in the artificial intelligence space, and they had one hell of a quarter during the second quarter of 2024. They came out and reported a 31% increase in revenue all the way up to $183 million, swung to a profit of $13 million after losing about $50 million in the year-ago quarter. Beat estimates across the board. They registered a 126% retention ratio, and they increased large customers, or customers that spend more than $100,000 per year, with GitLab by about 33%, which when you combine that with a retention rate that's above 100%, hella bullish for this company, especially as artificial intelligence and that wave starts to truly impact fundamentals of these smaller cap, not small cap, but smaller cap tech companies. And I mean smaller cap compared to the Mag 7 and all those giant ones that nobody can shut the fuck up about. But keep in mind, there are other artificial intelligence players on Earth than fucking Microsoft and NVIDIA. So don't be afraid to go ahead and check out GitLab and some of the other players along with them. Speaking of artificial intelligence, Tesla has been making a whole lot of noise in this space since fucking Vietnam. It's really been one of the big things that they've been promising since 2003. So shout out to them for the foresight on that one. Although, to be honest with you, predicting a bull market in artificial intelligence doesn't really sound too hard. It's like, hey, this software program can do literally everything. Are you bullish on it? Like, fuck yeah, of course I'm bullish on it. Either way, the stock was up 4.2% for the session here today because Elon Musk was out here shit-talking everybody once again. So first and foremost, he did a whole lot of shit-talking, talking about competitors, and specifically Rivian and Volkswagen on Monday. Basically, Volkswagen was talking about, Volkswagen has committed to investing about $5 billion in Rivian going forward. Now, at the exact same time, turns out they're having to close down some of their plants in Germany for allegedly what seems to be the first time ever. Elon tweeted, how are they going to get the money for this? And, when Elon dunks on people, it gets bulls fired up on Tesla, apparently. But probably mattering a little bit more so, there was a post that Elon tweeted out basically talking about the company's nascent robotics division. So this is the Tesla AI bot. And he said, quote, there will be so many robots with a ... So that got markets fired up about the potential demand for this segment that Tesla hasn't even started to recognize revenue on just yet. So obviously everybody was a little bit more fired up about that. Plus, finally, the stock's been down 20% since July 10th. So, it really wasn't going to take much to get these guys a big up day. Once again, up 4.2%. Okay, moving on down into our shitty, stinky names. What's rotten of the day? We have ZScaler down 18.7%. This is the one who actually proved that you can have a worse quarter than CrowdStrike did within the cybersecurity space in the second quarter of 2024. This company, they came out, they beat earnings and sales estimates, surprisingly, based on the reaction that they had right there. They managed to pull in 88 cents per share on $593 million in revenue, but the full year guidance was very, very underwhelming according to the fucking stock price, apparently. So they came out and said that they expect about $2.84 in terms of full year earnings. They also expect about $2.61 billion in revenue. Now, that sales estimate was in line with market consensus. So that wasn't necessarily the bad part, but $2.84 was slightly below what markets had been expecting going forward. So combined with, concerns around the artificial intelligence market stemming from NVIDIA's latest earnings report, this was kind of a double whammy to the downside. So lower guidance plus lower hope for the company's place in the artificial intelligence race. Didn't mean to make that rhyme there, but I'm very happy that it did. Nonetheless, let's go ahead and move on down into Dick's Sporting Goods. So, Sporting Goods Company, they absolutely blew past estimates. Blew past estimates despite a very hard quarter. And customers apparently were out here just purchasing so many bats and balls that they could have just told analysts to suck their Dick's Sporting Goods. They basically reported $4.37 per share against estimates for $3.83. Say, David, that sounds great. They beat the fuck out of earnings estimates. And I would say, absolutely, you're right that they did. But once again, guidance was relatively underwhelming. So really wasn't even that bad. But the company came out and the low end of their guidance was slightly lower than what consensus was calling for. This mixed in with fears about the retail industry that are ongoing right now because every other retailer in the entire world has had a relatively tough quarter. That kind of got markets a little bit soured on them, probably some profit taking because the stock has been doing particularly well compared to a basket of other retail names over the past few months. Okay, let's go ahead and move into our final story, our thought banana of the day. We are talking, of course, about how it's time to 𝗟𝗄𝗄𝗃. Now, if your dad was too nice to you and you don't know what 𝗟𝗄𝗄𝗃 means, let me enlighten you for a second. Basically, it's kind of a complicated topic, but it essentially just means quit your bitching, okay? Stop complaining, in other words, but in a very kind of folksy dad, New Balance wearing manner, I guess. Either way, you think Shakespeare was writing another fucking Greek tragedy if you went on finance Twitter and read any comment ever so far this year about what markets are doing? It's all doom and gloom. It's all, oh my God, there's a recession coming. What the hell are we going to do? How about we just stop and take a step back for about 5 fucking seconds and just look at the writing on the wall? So the reason that I'm writing about this here today is because Bloomberg came out with a piece, and this is one of those free Bloomberg stories that I was able to read. I don't have the money for a fucking Bloomberg subscription, but whatever, that's neither here nor there. But basically, Bloomberg came out and said that the exchange-traded funds, or ETFs, of major asset classes, including U.S. stocks, treasuries, investment-grade bonds, and high-yielding bonds have all been moving in a very correlated manner over the past 4 months. What I mean by that is every single one of those ETFs has risen during the has risen for the past 4 months in a row. And this is a very unusual dynamic because these asset classes are supposed to be uncorrelated. Now, some of you might be familiar with my good friend, the 60-40 portfolio, 60% stocks, 40% bonds, especially during 2022. But for much of the post-pandemic era, we've been wondering, is the 60-40 portfolio dead? Because stocks and bonds, especially again in 2022, had been moving lower in tandem with each other. So we just got hit with stocks and the bond side. This fucked up a lot of financial advisors and RIAs because that's kind of their typical business model. It's just to get people in the door, make them drink the Kool-Aid, and then sell them the same exact fucking portfolio that the advisor down the street would sell them. But nonetheless, that's neither here nor there. The 60-40 portfolio has been fucked in recent years, but the past 4 months, it's been the exact opposite of fucked. It's been working on both sides of the portfolio. So that kind of got us thinking, what's every other asset class been doing so far this year? And so we looked at a couple of the most important ones. And if we look at U.S. stocks up 16.57% for the year, international stocks up 8.97%, we have treasuries up about 71 basis points, high yield bonds up 2.39%, investment grade up 175 basis points. We have gold up 21.78%. We have Bitcoin up 31.53%, and REITs, real estate investment trusts, up 8.37% for the year so far. The only downside, and we already talked about this already, is going to be oil down 1.31% and a broader index of commodities down at 3.78%. Most of that is triggered by strength in the US dollar, which just once again confirms that everything is fucking off to the races so far this year. So really, I didn't include a quote of the day just yet. I probably should go ahead and include that, but I think it can be summed up in a line from a great movie, Ferris Bueller's Day Off. To paraphrase, markets move pretty fast. If you don't look around once in a while, you could miss it. This is one of those good times that we should take a step back, enjoy a little bit, and say, hey, you know what? Anytime you're feeling bad, open up your fucking brokerage app, and it's, unless you're me, it's probably up on the year, probably up on the day even. So just feel a little bit better about all of that. It's not all going to hell just yet. All right, that about does it for us here today, guys. Make sure to like, subscribe, boost our algorithm in some ways so that I can keep my job. That would be absolutely fantastic, so that I can keep coming on here, yapping to you guys and disappointing my parents, just some of the things that I am best at. Okay, I promise also I'm going to get a new setup. I know this is atrocious to look at. I thought that the editors or the developers or you know, whatever kind of technology it requires to put a picture in the video. I thought it required like a green screen behind me so that I could like move out of the way and have the chart there. I'm told by people much smarter than me that that is absolutely not what I should be doing. So I'm going to get a new setup here, something fun, something a little bit more unusual for the new Daily Peel Global Headquarters. And if anybody has any ideas, definitely shoot me an email, david@wallstreetoasis.com. Thoughtful emails will get thoughtful replies. With that said, happy investing, happy trading. And yeah, we'll see you guys tomorrow. Bye now.